Good afternoon, everyone. My name is Dale McGee. I'm with the United Equipment Dealers Association, and thank you for joining us this afternoon. It is my pleasure to introduce to you Rex Collins. Rex is a principal at HBK CPAs and Consultants and leads their dealership industry group. He has been working with equipment dealerships for over 30 years. Our association relies on Rex for his expertise in tax, valuation, estate planning, and more. Welcome to Rex.
Thanks, Dale. So we're gonna talk about Wayfair. How many of you have heard or seen the commercials on television for Wayfair? The online retailer, right? And you're going, how on earth can the online retailer that's selling all these home good type things impact me as an equipment dealer? Well, it has. So, and we're going to get into this. It's more than just rates. It's not about changing the tax rate. It's about changing a whole lot more. And there's a lot of different things there that we'll touch on. So as we get started here, a recent study has found that sales and use tax, as you can read up there, you guys can read, represent 22% of the state budget, basically. There's 50, prior to the Wayfair decision, South Dakota versus Wayfair, it was estimated that 52 billion with a B dollars in sales tax revenue was being missed by the states. 52 billion with a B gets the various states' attention. They have been aggressively trying to go after those tax revenues for years. Bill Garland's in the back of the room. He can tell you that we've been talking with the UEDA membership for at least 7 years about something's going to change and you're going to start being required to collect and remit tax to other jurisdictions. Now, did I think it would come about because of a Supreme Court decision, United States Supreme Court decision? No. I actually had said I thought there'd be some legislation in D.C. that would be passed to get through this. But we got a Supreme Court ruling last June, and that's important. June of 18 is important, and I'll touch on that a little bit later. So, Wayfair versus South Dakota. You know who don't care about that decision? Dealers in South Dakota, because it's talking about everybody selling into South Dakota. Now, what's happened since then? In the last year, a little more, we only have 5 states that have not enacted rules, regulations, similar to what South Dakota enacted. That has changed the game as far as defining what a presence in that state is. All right? In the past, we've had what's been called a physical presence test, where you had to be physically present in a state. You had to have brick and mortar there, so you had a location in a neighboring state. Boom, you've got an obligation to collect and remit sales tax. I have people doing work or doing sales in that other state. I have inventory stored in that other state, on rented property, whatever. I've got physically something there that has created this nexus. What the Wayfair decision did was took away, added to, didn't take away, added to what was 50 years worth of regulatory history and said, you don't have to just have a physical presence any longer. You can have what's called an economic nexus. You do enough business in our state, in this case it was South Dakota, if you do enough business in South Dakota, you will be required to collect and remit sales tax. Now, one little caveat about South Dakota. South Dakota does not have an income tax. Every state that has an income tax that has enacted legislation similar to economic nexus legislation has also enacted that relative to income taxes. So, there's a threshold in which you will be required to pay income taxes to these other states as well even if you do not have a physical presence there. So, you are concerned, as I live in Indiana, as an Indiana dealer, I am concerned about Michigan, Ohio, Kentucky, Colorado. This is anywhere I'm selling to. The South Dakota statute had a minimum standard of $100,000 or 200 transactions. Each state is different. Each state is different to the extent of, on October 1st, the state of Kansas passed rules that said, first dollar of business in Kansas, you're now required to collect and remit sales tax. You're now required to register to do business in our state. You're now required to pay income taxes in our state. If you sell ATVs and UTVs, many states, I don't know about Kansas specifically, many states require a dealer license, like you're a car dealer, to sell ATVs and UTVs. You'll have to do that. And when you get a car dealer license, oftentimes you have to get a bond for that. So this has gotten really deep and really heavy. All right? Reaching much more and much deeper than what you may expect. Alaska, for example, Alaska has no state income tax. Do you know that Alaska is in the process of passing legislation to permit their cities, municipalities, and counties to start assessing a sales tax to go after internet sales? Alaska has no sales tax, but you will still be dealing with compliance issues in Alaska for sales tax purposes, and you may be dealing with it in income tax purposes. Ohio, for example, right there. Ohio has municipality income taxes, right? Each city has its own income. You file income tax returns in the city in which you live, work, generate your income. If you are a dealer selling into Ohio, you need to know, oh, it's not just Ohio taxes, but it's the city of Maumee, Ohio, that I have a tax return to. Getting complicated. Everybody want to throw their hands out and leave right now? This is going to be the shortest session of the day, people, if you do that. So what I want to get at with this is you've got to know each of the states, but that's just the tip of the iceberg. You have to know each of the jurisdictions within the state. Colorado, for example. Colorado has a pretty low state sales tax rate. They also, in Colorado, will add city sales taxes to that and fire district sales taxes and a lot of different add-on taxes. I can literally be standing on this corner at a CVS pharmacy and buy product, have sales tax assessed, and if I went to the opposite corner and went to the Walgreens and bought the same stuff, I'd have a different sales tax rate in Colorado. That's how convoluted it is in Colorado. And ignorance of the law is not an excuse. You are required to know all this, okay? This is not a good session so far, is it, Pastor? All right? All right. So I've kind of already talked about this, but I've put some slides in here for everyone so that you can, if you want to take pictures, I see pictures being taken or whatever, or you want the slides for your own reading and reference with your CPA or your CFO or your staff, they're in here. So the old law was you had to have a nexus, you had to have physical presence, and we talked about that. Physical presence involved these items: having an office, having a warehouse, having a facility, having people doing work, storing inventory, drop shipping. That's creating problems as well. We've got a separate slide, a separate discussion on that. Okay? All right. There is also, if you temporarily cross the state line to go to a trade show and you're selling at that trade show, you've created a presence there. Okay? Physical presence is from the first dollar. There is no threshold. So if you come into my state That's it. You have, for example, if you go into Pennsylvania, there is, if you haven't filed, and this is with many states, they have they call it a franchise fee. It's the right to do business. It's an annual or biannual. In many states, just your registration in that state to do business. In Pennsylvania, it's not cheap. And there is no, I had a dealer in Ohio that got hit by the state of Pennsylvania saying, hey, we think you did business in our state, but you didn't file income taxes or collect sales tax or do these fees. There's no statute of limitations. We literally could have gone back to the first day they did business in Pennsylvania 25 plus years ago and would have had to pay the minimum fees of about $1,000 a year. Okay? We got it down from that to 10. We felt good. Okay? From that. So there are a lot of things that you need to remember, one of which is that physical presence is still important. So, as I talk about this, if you ever sell to another state and then you send a technician to go work on that, so let's say that I've got a customer from another state, they come to my facility, take delivery, and they take it back to their state. That's clearly my home state taxation, all right? Once I send somebody over to their state to do work on it, even if I sublet it out and hire somebody else to do it, I've now created a nexus in that neighboring state, okay? That's no different. That hasn't changed. That's been the way it's been for 25 plus years, okay? All right. And it doesn't matter if the manufacturer's paying you for it. All right. Quill was a 1992 case. It was 25 years ago plus. It was 25 years ago, and it was the seminal case that established physical presence. And I'll just very quickly tell you what that is. Quill did mail order. Quill did office supplies all over the country. And it was a mail order catalog that they sent out. And the state of North Dakota said, hey, wait a minute, Quill's doing business in our state. We want to force them to collect and remit sales tax in North Dakota. That went to the Supreme Court. They lost because in 1992, it was determined you had to have a physical presence. And that was backed up by, or it followed on the heels of 25 years prior to that, was a 1967 case that was decided. You don't even know this, but it's just a little bit of the history. And said physical presence, physical presence, physical presence. Back in 67 and 1992, this thing called the World Wide Web was pretty small. I don't think it's going away, guys. I think we're stuck with the internet, okay? And it's going to expand, okay? I got one chuckle at the back of it, that's good. But the world has changed. And that's why the Supreme Court ruling has changed to say physical presence is not the sole determining factor. The states have been, did you get that picture? Yeah. Okay, all right. The states have been going after this cross-border tax revenue for years. Ohio in 2005 or so enacted what's called a CAT tax. It's a gross receipt, commercial activity tax. It's a gross receipts tax for anyone doing business in Ohio. Ohio taxpayers and anybody doing business in Ohio relative to Ohio transactions. They enacted what was the equivalent of economic nexus in 2005, and it was upheld. Okay, so this has been a long time coming. After 2005, the states started going after sales tax aggressively, and we had different attacks on it. One of which was, for example, Colorado said, all right, if you don't have a physical presence in our state, it is onerous to force an out-of-state taxpayer to collect, register, and report and file, or send us the tax monies. If I'm in Indiana and I sell a machine to Colorado, that's onerous, that's overbearing. I don't have to do that under the old rules of physical presence rules. But what they decided was, it's not overly bearing for you to send us, and you're required to, a list of everybody you sold to in Colorado so that we can go chase them. All right? So they wanted the revenue. So that's been the law in Colorado for about 7 years. All right? Doesn't matter now because economic nexus has taken over. That's just how one reason one way the states were trying to get after this lost $52 billion in revenue. All right? So, again, what happened in the South Dakota case was South Dakota went after Wayfair. Wayfair's an online retailer, and they said, hey, you're selling more than $100,000 or more than 200 transactions into our state, and we believe you should be collecting our sales tax. Okay? They issued regulations. As an anecdotal comment, the Supreme Court ruled, I believe it was June 24th, okay? North Dakota, the afternoon of June 24th, after the Supreme Court ruled and upheld the South Dakota legislation, they passed their own legislation that afternoon to get in line. So North Dakota was the first to match South Dakota's language. As I said before, we have 45 jurisdictions that are doing this now. Okay? All right. The Supreme Court in the Wayfair decision said that the physical presence test is unsound and incorrect. You would replace those words to say that the economic nexus rules are unfair. And I'm not arguing with you, but it's $52 billion. We're not going to win that argument. Okay? And these are the reasons that they said that we need to go beyond a physical presence. And the reason is it favors remote sellers, internet sellers, over brick and mortar sellers. Well, you guys are brick and mortar sellers for the bulk of what you do. That's kind of a protecting thing that your states are doing for you. As a matter of fact, we had a meeting with one of the trade associations, lobbyists, and he was very proud of the fact that in their home state, they enacted legislation that protected the brick and mortar dealers. Well, but those are the same rules that we're talking about here. They're grabbing your sales that are going across state. So what's good is also bad. All right? All right? And you see, 41 states and D.C. supported the South Dakota legislation when it went to the Supreme Court. All right. Here, this first bullet point here is important. The safe harbor provision, the reason that the court stated they liked the provision in the South Dakota case was that it didn't start at $1. Remember what I said about Kansas just a minute ago, right? Kansas has said $1, we're there. When this passed, the only thing that the Supreme Court was looking at was the law as written by South Dakota, which was $100,000 and 200 transactions. They didn't say, well, maybe $50,000 and 100 transactions is okay, or maybe it's $25,000 and 20 transactions, or whatever. They just said, hey, this is fine. We like the fact that there's a minimum threshold in order to cross this. Okay? Now, it doesn't take very long if you're selling, for example, I know this is OPE mainly, but if I've got a $400,000 combine that I'm going to sell, it doesn't take very long to get over $100,000, does it? Okay, one piece of equipment. So it depends on what you're selling. And the 200 transactions, I want to emphasize that's hitting our parts departments, guys. We're sending parts, FedEx or whatever, we're sending them to other jurisdictions. So pay attention to that as well. The second bullet is also very important. We are already having audits. The states are being very aggressive in enforcing this. Last week, I got a call from a Pennsylvania dealer who is being audited on out-of-state sales. All right? So it's happening. Within the last 2 weeks, the state of New York has issued regulations, or has issued them for comment. They haven't enacted them yet, relative to income taxes on out-of-state, or from out-of-state dealers. So they're going to come after you for income taxes as well. But in these audits, some of the agents are trying to apply that back. So we've got a 3-year statute, let's say in, pick a state, doesn't matter, Ohio. So they're going to go in and look at you for 3 years. The Wayfair decision is only effective from that June of 18 moving forward. So they can't apply that. They are not supposed to. And the Supreme Court kind of sort of said that. Okay. All right. That is, okay, the 20 states that have adopted the streamlined sales and use tax agreement, that's really just anecdotal. That's just there to let you know. There is a coalition, you guys have heard of 20 groups. You may know Bob Clements has 20 groups together and so forth, right? The state attorney generals, the state departments of revenue, they all get together and share notes, just like a 20 group as well, all right? And so all of the states are comparing notes on this stuff. All right. This is what I mentioned earlier with regards to the Colorado example of if I sell to a customer, I may not have to collect and remit, but I had to report. There were 9 other states, okay, that did that. We've talked about remote sellers. We think about those as only being internet-based companies. It's not the case, all right? The term applies to any company that does any of these things: online sales, purchase orders, drop shipping, telephone orders, automatic replenishment orders. But I'll also tell you where we're getting into problems is even if they're not coming and finding you by the internet, but you're delivering their equipment to them across the state line. Okay? In the past, the customers have wanted to try to avoid, let's say I'm in Ohio. I'm an Ohio dealer and I have a Kentucky customer coming. He wants me to deliver to him in Kentucky because he doesn't want to pay Ohio sales tax. And he is probably going to try to not pay Kentucky tax as well. That's up to him. All right? By the Wayfair decision being enacted, assuming that I've met the threshold for Kentucky, and let's assume that's $100,000, I've already done that, okay? I now, as the dealer, have created an obligation to collect and remit Kentucky tax, potentially, if I've gone above the threshold. A comment that I want to make is when you're calculating the $100,000 exempt sales account. So your farm exemptions, your mining exemptions, so forth, that all count towards that $100,000. So I might have $99,000 of exempt sales, and then I have a $10,000 ATV or UTV that I'm selling to somebody. I've now crossed the $100,000, so it's taxed. And again, there's a chart that we'll go through, or that I'll show you in a little bit, that shows the various states. Shipping and freight. I'm not going to spend a lot of time talking about shipping and freight, but with regards to shipping and freight, it typically follows the taxability of the equipment. It's either taxable or non-taxable, depending on the taxability or non-taxability of that equipment in that state. So while you may believe in your state freight's never taxed or shipping is never taxed, if you go into another state, it may be taxed. Okay? So pay attention to those things. All right? Oh, I'm sorry. I'll let you get that picture. All right. Now, the next thing we're going to talk about is drop shipping. Okay? The left side of this slide is for the manufacturer. And it's a decision tree for them to determine whether they have a taxable transaction. The right side is for us. Okay? So I've got this decision tree up here. And the first thing that it asks, and I should phrase this differently, it says, does your company have nexus? And I mean physical nexus at that point. Do you have physical nexus in that state? Anyway, if you do, then yes, as long as it's not a tax-exempt sale to a tax-exempt organization or ag or mining or whatever, then yes, I'm going to collect and remit tax. If no, I don't have physical nexus, then has our supplier for us, so have I had drop shipments over whatever the specific state minimums are, 100,000 and 200 transactions in our example with South Dakota, which is what I'm using on here, then I've got to go down to the next decision tree. And there's an asterisk on there, check your state, okay? Check whatever state, destination state it is, okay? All right. So if the supplier has, then it's a yes, and I've triggered a sales tax obligation. All right? All right? If it's no, then I come down here and I say, well, I may not have a problem, but does my supplier? And if my supplier, ultimately if it does, then I have to fill out, the dealer, has to fill out an exemption certificate. Have you ever had to fill out an exemption certificate for your supplier? No, but you do now. Because these suppliers, your manufacturers, have been audited by the states, and they're getting hammered because you, the dealer, have had drop shipments into another state, and they aren't being able to provide exemption certificates, valid exemption certificates for that state. Let's use Michigan as an example. Michigan, and this is complexity for you guys. I've got a dealer, we worked with a dealer, as a bush hog dealer, sorry. A bush hog dealer, all right? Bush hog is all over this, all right? This bush hog dealer literally sent drop shipped equipment to like 45, 46 states. I mean, it was just all over, all right? Bush hog is going to charge him tax right on the invoice, on the drop shipping it. It's clearly for resale, right? You're not drop shipping it. You know, it's going there to be sold to a customer. And we don't have a presence there. But bush hog is requiring the dealer to provide an exemption certificate. In Michigan, one of many states, in Michigan, for example, you cannot provide an exemption certificate unless you're a registered retail merchant. So I have to register to do business in Michigan in order to get an exemption certificate, a valid exemption certificate, in order to not charge tax on a drop shipment that went there. And I'm going to do no other business in there. Well, guess what? Michigan's going to be knocking on your door saying, hey, you asked for a retail merchant certificate in this state. We think you've done business here. Where's your income tax return? Where's your sales? And you're going to be required then to file sales tax returns every month, so forth. Anybody any happier now that we're another 20 minutes into this conversation? I'm thinking no. All right. So this has gotten complicated and complex, and it's a burden upon the dealers, but that doesn't change the law. This topic is the topic that I'm getting more calls from dealers that are not clients of ours, that the associations, whether it's EDA, UEDA, Northeast, any of the associations, they're forwarding the calls to us, and these are where the dealers are giving us calls, and they're giving us the calls most often because an agent's sitting there, auditing them and saying, hey, all right, so how do I apply these thresholds? First thing is, it's a 12-month look back. It's a 365-day look back. So I do a transaction today with somebody in a neighboring state. I have to look back 365 days to determine whether I'm over the threshold. Every day that one could fall off, one could be added. It's constantly going to change. All right? Side comment. Your DMS systems are probably not tracking this for you. They're probably tracking who you're billing it to. So I may have a company who's buying equipment from me. They're in Indiana, but their equipment's, so I'm billing it to the Indiana home office, but they're actually in Michigan, for example. All right, doing their work. So you have to somehow figure out a system to track, and your DMS is the way to do it, easy way to do it. Would seem to be the easy way, but they're not programmed to capture that information right now. All right. Ag exemption. I mentioned this earlier. All right. These gross sales thresholds, those ag exempt sales count towards getting there. All right. Here is the chart. All right. This was updated as of October 14th. Should be a date on there right there. No. Somewhere there's an October 14th date on there. The only reason I'm saying that is these rules and regulations are changing dynamically. I mean, we've been having changes weekly as to which states are passing, which states are changing their thresholds. As I said, Kansas, let's see if I can do my alphabet here. Kansas, there's no sales or transaction limit. First dollar, first transaction, first dollar. And that changed October 1st. So we are working very hard to stay on top of this. We are providing it to EDA, we're providing it to the associations. So contact your association, contact us when you're doing a transaction with someone from another state. All right. Once you are registered in a state to do business, it doesn't stop there. You're going to be held responsible for doing all the filings that are associated with that. These annual registration fees, the retail merchant certificate fees, any of the bonding, minimum taxes. California is huge. Pennsylvania's franchise tax is significant. All right, these are big items. Don't forget about the local municipalities taxes. We've just got Colorado and Alaska on there, but don't forget, like I said, Ohio and other states. So another point that we're making, and we're doing some talking about this, about dividing into a separate entity, potentially the parts departments, into a separate entity, so that we're tracking these thresholds separately for the parts department and my sales department in a separate company. So it could it's tracking a separate $100,000 threshold. So that in the thought process is our parts are going to be more likely to hit the unit number, the transaction number of transactions, and our dollars are going to come from our holdings, if you will. So this is a thought right now about doing this. I don't think it's a bad thought, but you would then be filing. Well, you'd have some additional filing requirements, setting up two corporations instead of one. In essence, to only something like that. But the problem that we're seeing is the online parts divisions are doing so many transactions that the very first transaction we send across state lines from the whole goods side, ouch. Is that what you just said? I think you said ouch. Ouch is right. I've got a violation, okay, or I've got a requirement. So we're trying to be proactive with this. Okay, exemption certificates. There's a crackdown on the exemption certificates. First of all, bear in mind, ag exemption. The definition of agricultural use is different from state to state to state. So just because you're familiar with your own state's ag exemption rules doesn't mean that matches the next state. Timber is an example that I use. Timber is exempt under an ag exemption in many states. It is not covered and exempt at all in some states. All right? So you now, when you go into that state, have to make sure you abide by that state's rules. What do I suggest that you do? From this perspective, if I'm having a customer pick up the equipment in my store in my home state, I'm going to have them fill out 2 exemption certificates. I'm going to have them fill one out for my state, and I'm going to have them fill one out for the home state, or for their home state. All right? That way, I've got it. All right? I just spent an hour and a half on the phone yesterday with a dealer who the exemption certificates are a problem for. And you guys need to know this. Every farmer in the country believes that everything they ever buy is covered by an ag exemption. Anybody going to disagree with me? I think not. All right. The problem is, we know that the general rule in most states is to be covered by an ag exemption, whatever they're buying has to be predominantly used, that's more than 50%, in the production of food products. I'm paraphrasing, but that's basically what it is. Somebody comes in and buys a string trimmer, chainsaw, a mower. Is it being used predominantly in the direct production of food products? And that's what we're getting hammered on. This dealer took, on good faith, and there's no question, the Department of Revenue is not questioning that, took on good faith from the farmer that it was a valid exempt use for some of this stuff. And he's getting hammered. His comment to me, complaint to me is, every other dealer in my market area is not charging him tax either. So it's a business decision. You should be remitting the tax even if you eat it. You know, take it out of your gross yourself. Okay? And I got news for you. If I've got a guy who's buying a $400,000 combine every other year, yeah, okay, I'm going to eat the tax on his string trimmer. You know, I mean, it's just a good business decision, right? If I think that's going to make him mad and he's going to go elsewhere, which is this dealer's comment. What you should be doing, our best recommendation for you along those lines, is to have an affidavit signed from them if they're buying something that could lend itself to for consumer use or personal use. To have a separate affidavit, we've drafted one, that says, it's a check the box. I'm buying this chainsaw, all right, and I'm using it, yes or no, predominantly for, okay, then agricultural use or mining use or whatever it is. And then I'm also having the farmer attest that he's planning, okay, to use it more than 50% of the time for that purpose. That will help you, okay, in an audit. So you've got to get not only the exemption certificate, but for those items that lend themselves to personal use, you need to have this affidavit as well. Or you're playing audit roulette that the agent won't question. All right. I go to Vegas frequently. I don't gamble because I don't like the odds. I don't like the odds on playing audit roulette here either. All right. All right. So some questions that I want to go through. These are thought starters for everyone. Do you actually know your footprint? Picked up a dealer client with construction equipment down in the southeast. We did a nexus study. Found out that he was, and especially equipment, and he knew he was sending equipment a lot of places. Some rental, some sale. Okay? Do you know your footprint? He ended up writing checks that totaled about $1.5 million voluntarily to comply with these various states' nexus rules. Why did he do that? Because if you get audited, you can double the 1.5 by the time you get interest and penalties in there. All right? So it's expensive to not comply. All right? Now, okay. I know I'm being recorded, so don't do this. All right? But I have had guys say, you know what? I've been doing this for 12 years. They came in and audited me. I got caught for 3 years. I win. All right? That's not a good idea. All right? Blatant disregard will get you a lot of problems. Yes, sir?
Just a quick question on the affidavit. I mean, on our invoice, we actually have a statement to that effect. It says, by selling this invoice, you agree that you were using this for agricultural use. Would that actually help us out?
Very minimal. Very minimal. It's canned language. It's probably fairly small on your invoice. And the Department of Revenue is going to say, nobody's reading it. And you're shaking your head yes. So it's not that. It's the fact that it's a separate document, that it is, hey, you know that this, we're making you aware of the problem. So it's better than nothing, but I don't think it gets you very far. Okay? It shows your intent to comply, which is good for us. Okay? From a, hey, we're trying to do what we can. And that gives us some good marks. Okay. So I suggest that you try to put a fence around your footprint. Okay? And by a fence, on your sales documents, the actual buyer's order, or your sales invoice, signed by the customer, you need to have delivery is taking place at my location. Delivery will take place at 123 Main Street, the next state over, or Colorado, or wherever it is. Okay. That puts a fence around it. You can easily identify these are Indiana transactions, these are Colorado transactions, these are Ohio transactions, so forth, by doing that. It's not the end-all be-all, okay? But it helps us. Let's talk a little bit about delivering the equipment. My best advice for you is to use a third-party transportation company to deliver the equipment. That clearly documents where delivery took place. Okay? Now, historically, we've said, hey, you want to hire the third party. You can pass the fees on, but you want to hire this third party. And that's been typically because if the third party is hired by your customer and comes to your location and picks it up, it's no different than if the customer came to your location. They're the customer's agent. And so that's created a transaction in your state. Well, in the past, prior to this, these customers will want, no, I don't want to pay tax in Ohio. I want to pay it in Kentucky, and then I'm not going to pay it, okay? Nowadays, I think that's changed, and I think we would like for it to be clearly established that it's our state, because I don't want to be caught with nexus issues, economic nexus issues, in these other states if I can avoid it. We have had audits. We had an Ohio dealer audited by Kentucky. Ohio locations audited by Kentucky. Kentucky comes in. First thing I did was I said, we don't think you can come up here. You don't have jurisdiction. Now, I will tell you, they have jurisdiction. I was puffing out my chest and trying to say, I want to know what you want to look at, because I don't want to give you everything, which they have a right to. I want to give you what you want. I want to put a fence around what they're going to look at. Okay? And we did that. We gave it to them. They wanted basically anybody with a Kentucky address. Fine. That's what I expected. I didn't want to look at anything else because we may have made some mistakes somewhere else, right? So they looked at those. We ended up with one transaction, and only one transaction in which we could not, to the satisfaction of the Kentucky Revenue Cabinet, the Department of Revenue, we could not prove to them that delivery took place in Ohio. So we were guilty until proven innocent. Okay, everything was assumed to be a Kentucky transaction unless we proved otherwise. We had one and only one transaction that we couldn't prove to their satisfaction. So what did we do? We paid the tax. We paid the tax to Kentucky because it was cheaper than fighting them. The professional fees and so forth to fight them was more than what it would be. Now, the customer had already paid us, and we had remitted Ohio sales tax on that same transaction. So that same transaction was taxed in Ohio and Kentucky. That should never happen, but because we didn't have records and couldn't prove it. Ross?
Rex, in lieu of using a third party truck, if we set up our trucks as a separate rental entity for other reasons,
Yep.
that suffices.
It does.
As an arm's length transaction.
It does. It helps us tremendously because they're treated just like a third party. We've done that as well. I will repeat that in case you couldn't hear. Ross said, what if we took our rolling stock, our trucks, trailers, and so forth, set them up in a separate entity? We've been doing that for other reasons for a long time, tax and non-tax reasons, okay? But if you do that, that counts as a third party. All right, now you've got a filing requirement for that. You've got what you have to do there, but it's a good move. It will get you that third-party protection. If you are going to use your own rolling stock inside your corporation, there are some things that you need to do. First of all, In addition to the buyer's order that I talked about, send your driver with an affidavit and have the customer sign and date that affidavit that at 2:45 on Thursday the 17th, I took delivery at 123 Main Street in Henderson, Kentucky. All right? I took delivery as the customer. Next thing I want you to do is I want you to have that driver take a picture of the equipment on the trailer in front of 123 Main Street. And the next thing I want you to do is I want you to have that driver stop at the nearest gas station and buy a Tasty Freeze or a pack of gum or something and bring the receipt back, because that receipt is date and time stamp. Do you know that I've had the signed affidavits provided to the Department of Revenue, and they've said, we think you and your firm, your customers are colluding with one another. And when they've ignored it, we've had $500,000 assessments that we've had to fight. So this is not small money, folks. Okay. Some other questions. I've talked about putting a fence around it. Do you have the tools to know where you are and where you're doing business and so forth? Do you know the taxable status? That's ag exempt, mining exempt, what qualifies in states versus in your state versus the other states. Labor. In some states, labor is not subject to sales tax. In other states, labor is subject to sales tax. Same way with delivery charges and so forth. So keep that in mind. Do you need to collect exemption certificates? We've already talked about that. The answer is yes. We've got some examples here of some other issues, but I want to go through my notes here and make sure that I talked about everything with regards to Wayfair. Don't forget, so I'm going to re-emphasize a little bit, don't forget, this is not just sales tax. I've spent the bulk of the time talking about sales tax, but you're going to have income taxes, franchise taxes, registration fees, dealer license, etc. The New York regs have been issued at this point dealing with income taxes. All the other states that have a state income tax are going after the same thing. They've already got it in their legislation. Yes?
Would an ESOP be exempt from both state income tax?
Well, in most instances, yes, because you get some benefits with an ESOP. That's correct. Yes. So I would really want to look at each one of the states to answer that correctly. So the question was, would an ESOP give us any benefit in these states? And the answer is quite possible. Also, don't forget, these income taxes, if you're a flow-through entity, a sole proprietorship, a partnership, an S corp, an LLC, you individually will be filing income tax returns in all these states. Oh yeah, and don't forget the city returns. You're going to personally be filing in all these cities as well. All right? The headache just got bigger. All right? We went through the chart. I talked about the DMS. I talked about putting a fence around it. Talked about the dealer with the 1.5. Talked about the central PA dealer with a $110,000 assessment. $500,000 assessments I talked about. The one deal, labor, and exemption certificate in Michigan. So I did talk about all the examples that I wanted to talk about. That's good. Okay. And we've got like 2 minutes. We've got other issues that are going on. Okay. Maine, for example. All right. And I'm not sure how many of you do business in Maine, but Maine has taken basically they are trying to tax, for sales tax purposes, your volume discounts. Okay, they're not the only state that has tried to do this. We have won those, okay? And very quickly I'll just say there's a difference between a customer rebate and a dealer rebate or a dealer incentive. A dealer incentive is a reduction in my cost of the unit and is not subject to sales tax. The customer rebate is subject to sales tax. An easy way to think about this is if you go into the car dealership and you see these ads on television and it says $1,000, you can apply it to the unit, you get 0% interest, or we'll mail you a check. That's customer cash, because the customer controlled it. They had some degree of control. Okay. The stair step money, the other things, no control. All right. And it changes the tax. All right. We've got in Wyoming, and we're not going to have time for open discussion, but I'll be here. So we can talk individually or at Wyoming. Did I mention Wyoming already with regards to the ag exemption? I don't think I did. I've been in board meetings and I've mentioned the same story a few times, so I apologize if I'm more repeating. Wyoming, an auditor came into a dealer in Wyoming and looked at the ag exemptions and made the statement that, oh, Wyoming ag exemption is only applicable to Wyoming farmers. Which means this equipment dealer that was selling equipment to Nebraska, Colorado, the neighboring states, they were suddenly taxable for all of those transactions, which we're talking millions of dollars. Okay? Now, that was an agent. The reason I'm saying this is the agents can make it up if they're not sure, make up the law, and they're not well versed in this because today they're at your dealership, tomorrow they'll be at an HVAC contractor, the next day they're at a restaurant, the following day they're on the bourbon trail at one of the bourbon distilleries, you know, I mean, whatever. They're in different industries. They don't know the business, all right? They don't know the case law in their own state. They don't know the regulations in their own state that impact, case law and regulations that impact your industry. Accordingly, that's why we're getting a lot of calls. And we don't charge for the phone calls, guys. So just call us if we can help. We will. If it goes to where we're on the phone for an hour or so, hey, you got a bigger problem, and we're going to probably talk. What I would caution you against, and we do this all the time, is call us when you get the notification that you're being audited. We need to put fences around the agent. I have worked with numerous dealers where we've not charged them a thing because I've coached their internal accountant, their external accountant, CFO, whoever it is, on, okay, here's what you need to be aware of in Wyoming, in whatever, if they're coming in and you're, especially now that it's across state lines. All right. It is 2:50. I'm going to stop, okay? But I am here. I'll be across the hall at the EDA booth as well. If there are any questions that anybody has. And, yeah. The dealership hotline gets answered during business hours, East Coast time. And we direct it to another member of the dealership industry. My cell phone rings right to me. So, and those of you that know me know my phone rings frequently, and I answer it. So, anything anybody want to, any comments, any more stories, anything anybody want to say? Yes?
Could you put that slide up that showed the states?
Yep, I sure can. And I thought I saw a hand up here. So speak up if there was anything. Yes?
When you say you hit 200 transactions or 100,000, you don't charge tax until that point. Once you hit it, it becomes active at that point. You got to go backwards and get it.
No. It is, you are not subject to the rules until you hit that 200th transaction. So you don't have to charge and collect tax on the first 199. And then you've crossed the threshold. Now you have to do that for every transaction going forward. A 365-day look back though. So I may have 10 transactions that fall off and only have one more. I'm back to where I don't have to.
So it happens. You can go either way.
It can. And it's try to keep track of it. It's tough. I think from a practical standpoint, dealers are going to, on the parts side, once they cross, they're just going to collect it, okay, for that time period. Yeah. Yes.
How about the Wisconsin legislator that has something passed on the federal level? He's trying to protect that 100,000, 200 grand. Anything on how that's going to pass?
Federal legislation on this is that what you're talking about? Yeah, it's extremely unlikely to have anything happen. Because we've got 50 individual, well, you've got more than that jurisdictions, but you got 50 individual states. Sales tax is clearly a state matter, and so it's going to be unlikely. Now, if we roll back 7 years ago, what I've been saying 7 years ago back until this was passed, I didn't think this was going to come out as a result of the court case. I thought it was gonna come out legislatively, and the federal government was gonna say, okay, here you are, all you states need to do this. I don't think that's going to happen. I don't think it'll get any traction.
Yeah, I think there is a bill,
Yeah.
but it's possible.
Thank you, everyone. I think there's another session in here.